everybody. Welcome to Cordant's year-end market update for 2021. In this video, what we're going to take a look at is what the markets did last year. We're going to look at what happened in the fourth quarter, and then we're going to take a look at 5 big investing themes from 2021. And we'll conclude with what we're paying attention to for next year. All right, stick around. We'll get right into it. So what happened in 2021? Here's a chart of global equity markets. And as you can see, over the year, markets were largely up. We had a couple dips, but for the most part, markets were up and about a 20% return for world markets. That includes both US and international stocks. More specifically in the fourth quarter, a good quarter for the markets after being down slightly in the third quarter. Markets were up in the fourth quarter, led by US markets. International markets up about 3%. Emerging markets, the lone area of the market was down slightly. The real estate's up, and bonds and U.S. bonds both and international bonds were up slightly in the quarter. Diving into each of these areas more specifically, in U.S. stocks, again, up in the fourth quarter, led by large growth, large value, about an 8% return, and small cap stocks. Also up in the quarter, up less than the large cap stocks. Although for the whole year, small cap stocks were a good place to be. Now, as a reminder, U.S. equity market makes up about 60% of the equity markets worldwide. That's up from about 50%, 5, 6, 7 years ago. So it's taken a larger chunk of the global equity markets as the U.S. stock market has performed well over the last decade or so. International stocks, again, up in the quarter here, led by growth stocks and large stocks, similar pattern that we saw in the U.S. market. Value came in at about a 1.9% return in U.S. dollars, and small cap just eked out a small positive return. International developed stocks, so this is Europe, Japan, etc., make up about 30% of the world market right now. Emerging markets, as we saw before, down in aggregate. Small cap stocks did eke out a small gain in the international markets. And again, 11% of global equity markets here in emerging markets. The other thing that we've been paying a lot of attention to here in 2021 is just commodities. With inflation being higher, interest rates rising, commodities have been a solid performer on the year. Fourth quarter, small negative return. But again, for the year, commodities had very positive returns. Okay, now that we've looked at what the markets did in the fourth quarter and over the last year, I thought it would be interesting to look at 2021 through the lens of some big investing themes that I was paying attention to through 2021, and some of these that should carry over into 2022 as well. So, okay, and the first one that's on a lot of people's mind, theme number 1, is inflation. Obviously, we've had some inflation numbers that we haven't seen for decades, multiple decades here in the fourth quarter of 2021. First, I think it's worth taking a quick step back and just recapping what are we talking about when we're talking about inflation. So I thought this kind of infographic did a pretty good job of breaking it down just at a very high level. So what is inflation? Well, it's simply prices going up over time. It's not necessarily good or bad. It's relative. Our prices going up more than other things that might offset that. So income, for example, for any individual, if prices go up, but your income goes up more than what the prices of the goods you're consuming go up, you're actually better off. Sometimes it doesn't feel like that, but from a pure dollars in your pocket to purchase the things you need, that is true. So what causes inflation? There are a few causes. Again, some of these things can be good. A strong economy, a tight labor market like we're seeing right now, low unemployment rates can cause inflation to go up. High energy prices or raising energy prices that are going up can cause inflation as well. We're seeing some of that. Oil has performed well. Price at the gas pumps have gone up over the last year. And then government policy, something that, again, we've seen a lot of in the last couple of years since COVID. A lot more government spending that potentially can trickle through to inflation increasing like we're seeing right now. So CPI is kind of the thing to pay attention to. There's two measurements of CPI. There's what they call core and total CPI. Core tends to strip out food and energy prices. The case there is these things can be more volatile. So usually the headline number is going to be including both food and the prices of fuel and energy. Sometimes economists look at core CPI, which strips those out as well. Now, good and bad. Like I said, inflation can be both positive and negative. Some of the positives of inflation, higher paychecks, can be helpful in terms of helping the economy grow. And it also, if you're a borrower, especially if you're a borrower of fixed rate debt, so think of your mortgage. If inflation goes up, your home value is worth more, but that debt stays the same. So it actually shrinks in real terms. Negatives, obviously, are higher expenses. The economy can get overheated, cause a recession. And if you're a lender, it's bad for you. If you're getting $100 back and that's not worth the same thing it was when you lend it out, that's not a good thing. So real quick recap of inflation there. What have we seen over the last year? So this is actually going to go back to 2000, but obviously 7.1% inflation. That's total CPI, not the core that we were talking about before, but the highest number we've seen since 1982. So definitely have seen some higher numbers here. I think the big question on everybody's mind is, how long does this continue for? Does this stick around? Are we in for a period of higher inflation or not? I mentioned before that it's relative, and I think that's the key thing to keep in mind with inflation is how do some of the other areas that we can invest our money perform when inflation is high. And so there's a lot of data here on this chart, but what we're looking at are real returns, which mean if you ever hear that term, real returns, what it means is returns above inflation. And so the data we're looking at here are take all the years and take the median inflation rate, the middle inflation rate, and let's look at all the years where inflation was above that middle point. How did different asset classes perform? So there's a lot on here. I'll focus you in on the different areas with arrows here, some of the better performing areas of the market. Before that, though, here on the left of the chart, you see some different bonds. You see very short-term bonds, 5-year, longer-term, government and corporate bonds. And first thing to note here is actually maybe a bit surprising. On average, these areas of the market still do deliver a slightly positive return, not a huge return, but slightly positive above inflation return. I will, however, focus you in on these areas of the market with the arrows on the chart here. So first one, just the general equity market, almost a 5% positive return above inflation in the average year where we have above average inflation. Some of the areas of the market that do better than that, the energy industry, obviously, almost a 10% return. That's probably pretty intuitive that you'd think that'd be one of the better performing areas of the market. Maybe less intuitive, small cap value particularly, almost a 12% return above inflation. Large cap value, 8%, and the value premium in general. So this is value above growth, about a 5.5% positive return above inflation. So growth has beaten value here the last few years in the recent past. Certainly out of 2020, out of the recession and the bounce back, growth did well. But in a inflationary environment, value can tend to outperform. And we'll look at value versus growth here in a second as the trend. But I think it's worth framing this from an inflation lens, what actually performs well and how do the markets in general perform when we get above average inflation. And conclusion here is there's still ways to make money. There's still, on average, different areas of the market tend to perform. Equity markets tend to perform even if inflation comes in and continues to come in above average. Okay, shifting gears to our second theme, which is value versus growth. So we talked about this in the light of inflation, but just value versus growth generally. So here we're looking at a chart going back to the beginning of 2020 through the end of 2021. And what you can see is a pretty good run up. So what we're looking at is basically the performance of growth divided by the performance of value. So if this chart is above zero, growth is outperforming value. If it's dropping, if the line is declining, value is outperforming growth. And what you saw from the beginning of 2020 through basically October or so of 2020, growth pretty dramatically, about 45%, outperformed value. Since then, we've seen value actually outperform to about 20%, 19%. Values outperform. So that's something that was a big theme, kind of this run up for growth and then the shift late in 2020, and something that we'll definitely keep an eye on going forward in 2022. On the small cap side, so small company stocks, same pattern but different magnitude here. So originally growth outperformed by about 35%. We've seen essentially a huge reversal of value getting almost back to even over this period. And small cap stocks in general were very strong performers over this period. Looking at inflation again, value tends to do well in an inflationary environment. So here we're looking at the inflation rate versus the performance of value versus growth. So the farther out to the right we go, the higher the inflation. The farther up we go, the bigger the outperformance for value. And you can see during these decades of higher inflation, value has tended to outperform growth. So again, something to keep an eye on there. The other thing to keep an eye on with value, or one of the themes is, one of the reasons growth has outperformed is that value has gotten cheap, very cheap, at least relative to growth. And so here we're looking at across the world, across multiple different ways to measure value. Value is actually, value is always going to be cheaper than growth, but you can measure how cheap it is relative to the growth stock counterparts. And what you can see here is there have been periods in the past where value has gotten pretty cheap. We're at a fairly extreme valuation for value. Value is pretty cheap right now. These other periods is the tech bubble, late 90s. This is the global financial crisis, 2008, 2009, were some of the other points where value got pretty cheap. And what's interesting to look at is, okay, when this happened, what happened in the period that was to follow? And so here's some research that Alpha Architect did, and they looked at both the US and the international markets in these two periods that were circled. There's two periods in red from the prior chart. So they looked at the 2000 to 2004 period and the January 2009 through the end of the year 2013. And what you can see is, value did outperform, did recover from these periods of extreme valuation. In green, you have kind of the total market. So the US, it'd be at S&P 500 against two different ways to measure value. And you can see 2000 through 2004, S&P 500 was actually down a little bit over that period, whereas value was up about 28%. 2009, US market up about 18 versus 31 for value. In the international markets, similar pattern, down slightly in the first period for the total market, but up for value. And the second period, up a good return actually over that period for the markets, but value did even better. So again, second theme we're paying attention to in 2021 is just value versus growth, kind of the value of value right now, and how these will perform going forward. Okay, a third theme that we are paying attention to and hearing questions about is, should we be investing now that we're getting back to all-time highs? What does it look like? And just a couple quick charts on this, looking at it from two different time periods. So since 1926, what happens when you invest at an all-time high? And what you can see is basically pretty similar returns if you invest at all-time highs versus just any random month or any random level. If we zoom into since 1988, different analysis by a different company, different date period, but you see a very similar pattern. So 1 year, 3 years, 5 years, the returns are going to be different because these are cumulative versus average annual returns before, but you see a pretty similar pattern. Positive returns if you invest in any day versus just at all-time highs. Okay, fourth theme, custom indexing. This is something that if you read the industry news like we do, started to gain a lot of traction, and a lot more companies are getting involved in this space. And something that we're actually starting to roll out for clients to give them the ability to tailor their portfolio a little bit more in certain instances where it would make sense. So let's talk a little bit about that. Just a really brief history, I guess, of investing, how it's brought us to this. To today, where we have custom indexing. So stocks are about 1602. Mutual funds came online, actually first one in 1924. ETFs, 1990, exchange traded funds. And then kind of today, brings us to today, 2016, kind of the first dynamic custom index, as they're calling it today. So what is it? What does it give somebody the ability to do? Well, index investing, so starting with really ETFs and some mutual funds before that, do a few things. So one, they're low cost. Costs matter. Taxes, they're pretty tax efficient. They have low turnover. ETFs have some attractive features that can avoid taxes in certain cases, or not pay out gains every year like mutual funds might have to. And then indexing can be a way to get exposure to factors. So we talked about value versus growth, or maybe large stocks versus small stocks. You can specifically select an area of the market you want to tilt towards and own more of that, and indexes give you ability to do that. The fourth chapter, as this phrases it, will be that customization piece. And the kind of the realization there is like everybody's not the same. So people might have different tax preferences. They might have a concentrated holding that they don't want to own more of. So if you work for a large, say, tech company, Intel, Microsoft, something like that, and you already have a large exposure to a company, you probably don't want to own more of that. Or maybe you want to tailor your preferences. Maybe you don't want to own a certain type of stock. You don't want to own tobacco stocks, for example. It gives you the ability to screen that out. So why now? Why is this coming online now? There's a few trends that have been happening in the industry that give the ability to do more of this. So one of them is just cost. Commission costs have been coming down. A lot of custodians now offer zero cost trading. Fractional shares, it gives somebody the ability to buy a fraction of a company and build out that allocation without buying full shares. So more fully develop the allocation. And then just simply technology. The technology's now here to set these up, trade them, maintain them, and that technology. All these are sort of tailwinds that have enabled this. So again, this is something that's showing up more and more in our industry, something that we're paying attention to, something that we have a solution. If you may think this is right for you, we're probably going to bring it up and have the conversation. But if you think it's right for you from either a tax perspective or from a customization perspective, it's certainly a conversation that we can have. And then last theme number 5, is crypto, or more generally, this whole space. So whether that's NFTs, whether it's DeFi, whether it's the metaverse, etc., hearing more and more about this, and kind of going mainstream in this last year with some ETFs being approved, some futures trading being done institutionally in this space now. And so certainly something that we're keeping an eye on. If you look at just performance, Bitcoin being the largest asset in this asset class, this new and emerging asset class, versus traditional assets, kind of interesting. Still pretty volatile, but not kind of obviously good returns from this space, but not earth-shattering returns in 2021 like you probably saw in 2020 before that, or some smaller, what they call meme coins or something like that, might have had larger returns. But what you can see, Bitcoin relative to a commodities ETF, similar performance, mid to upper 40s, versus global markets, 20%, better than that, but not crazy returns that oftentimes you hear about in the media or something like that. So definitely kind of a new emerging, potentially an asset class, something that they're starting to become investment products that are geared around this. And so definitely a theme worth paying attention to, something that we're keeping an eye on and paying attention to, but kind of too early for prime time is kind of how we view this so far. So now that we've covered the 5 big investing themes from last year, I want to take a look at what should we be paying attention to in 2022, or what am I paying attention to in 2022? First one is just, will this value versus growth trend continue? We've had value kind of make a rebound. It's at attractive valuations. Does this continue? As of now, as of mid-January, value has outperformed growth by about 8% year to date. So off to a good start. Obviously, that's a short time period, but we'll keep an eye on that. US versus international investing. So again, the US market has had a good run. Things tend to be cyclical. So when do we see a change there? And again, it's early, but international has actually outperformed the US market by about 4% so far this year. And then obviously, we'll continue to pay attention to interest rates. How much do those go up? It seems like the Fed is going to raise interest rates this next year. How much do interest rates go up? And what happens with inflation? Has this peaked out? Is the 7.1% CPI number that we saw in December, is that the peak? Does it decline? Where do we go from there? And obviously, what does that mean for the economy? What does that mean for different areas to invest? So that's it. That's what I'm paying attention to in 2022. As always, let me know what's on your mind. What are you thinking about for this next year? I'd love to hear that and answer any questions you have. And hopefully this is helpful, and we'll be in touch as we go throughout 2022. Okay, thank you.